Today I'm going to talk about a term that a lot of accounting and finance people use, or people who just are interested in the profitability or understanding the profitability of any given company. EBITDA. EBITDA is a term that's often used when discussing how well a company is doing financially, but a lot of people don't really know what it means. And by the way, some people say EBITDA, 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 a lot of different ways to pronounce that. But EBITDA is an acronym, and it stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. EBITDA is basically operating revenues minus operating expenses, i.e. the core business sales and the costs of those sales. Operating expenses include things like rent, salaries, and inventory, but they don't include interest, taxes, depreciation, and amortization. When people invest in a company, they will want to know how much money the company has been making since their money was invested. EBITDA gives investors a feel for cash flow before debt payments, taxes, depreciation, and amortization. It's not the same as real operating cash flow, nor a measure of cash earnings, nor a true measure of a company's profitability. It's also not a standard accounting measurement. What it really does is enable managers and investors to see trends and know if the company is headed in the right direction. If the EBITDA figure seems to have a good growth rate, then some investors may use this figure instead of the overall net profit figure. EBITDA also has some weaknesses as a financial tool, especially for certain types of companies, but it's one of many measurements of a company's performance that are useful when painting the total picture. Wall Street analysts like to use EBITDA as a way to evaluate a company's ability to earn future profits. It's also a significant metric when used by debt holders, i.e. banks or other investors, who might extend credit to the company. The higher the EBITDA, the greater the company's ability to pay its debts. Most people know what interest and taxes are, but what about depreciation and amortization? These are both non-cash expenses. Depreciation is simple. It's the loss of revenue of a capital asset over time. If a company owns a truck, for example, they will write off some of its value each year for a certain number of years until it's completely written off. This depreciation expense makes income appear lower, lowering the tax burden, which increases final income. Amortization is the paying off of debt in regular installments over a period of time, or the deduction of capital expenses over a specific period of time, usually over the asset's life. More specifically, this method measures the consumption of the value of intangible assets such as a patent or a copyright.